Headlines typically focus on AI valuations or the shifting political landscape in Washington, but a much more mundane variable has been quietly anchoring the global economy, a factor rarely discussed outside of specialized finance circles. To find it, you have to look past the Federal Reserve and head straight to Tokyo. These are Japanese government bonds. For 30 years, this specific market has acted as a form of financial duct tape, providing a steady baseline for global capital flows, while the rest of the world looked elsewhere. That duct tape is now starting to peel, and as it does, it offers an answer to a persistent question: why financial conditions feel so tight, even as the Federal Reserve discusses cutting interest rates. This dynamic began in 1992, when Japan's massive asset bubble burst. Real estate and equities collapsed, triggering a 3-decade period of stagnation that essentially hit the pause button on the Japanese economy. To fight the stagnation, the Bank of Japan exhausted every conventional tool, eventually cutting domestic interest rates to zero, and then even lower, to force money out of bank accounts and into the economy. They eventually introduced yield curve control, which effectively meant the government forcefully capped long-term bond yields mere 0%. They superglued interest rates to the floor, regardless of what the market actually wanted. For Japanese pension funds and banks, this created an impossible math problem. With domestic bonds yielding nothing, these institutions were forced to take their billions of dollars overseas to find a return. This created the yen carry trade. Investors would borrow money in yen at near zero interest, convert it to dollars, and buy U.S. Treasuries yielding 4%, pocketing the difference between the two rates. When borrowing costs are practically zero, investors don't just stick to government debt. They use that cheap yen to buy tech stocks, real estate, and emerging market assets, turning Japan into the world's primary source of liquidity. The scale of this movement was massive, making Japan the world's largest net creditor nation. For decades, the global financial system essentially ran on Japanese Wi-Fi. But the entire trade relied on a single fragile assumption: that Japanese yields would stay near zero forever. In 2024, that assumption broke. The Bank of Japan ended yield curve control and raised interest rates for the first time in 17 years, snapping the 30-year trend. Markets were spooked instantly. The S&P 500 dropped 6%, while Japan's Nikkei index plummeted over 12% in a single day, its worst crash since 1987. As borrowing and hedging costs rise, the carry trade no longer makes mathematical sense. This has triggered repatriation, a massive reversal where capital that flowed out of Japan for decades is now returning home. The cheapest source of global liquidity has evaporated, and markets are realizing that the era of free money is officially over. Financial markets analyze every word Jerome Powell speaks, yet the Federal Reserve only controls one specific lever: short-term overnight lending rates. The long end of the yield curve, the rates that actually set the price of money for mortgages and corporations, is governed by a different set of forces. As Ray Dalio observes, the bond market is the backbone of all markets. It establishes the risk-free rate that determines the value and return of every other asset in existence. This creates a problem for the U.S. government, which runs trillion-dollar annual deficits. To keep the lights on, the Treasury must issue massive amounts of new debt every year, which requires a constant stream of buyers. For years, Japan was the most consistent buyer of that debt. If they pull back, the Treasury must raise long-term yields to attract new buyers, creating a steepening yield curve where long-term rates stay high, even if the Fed cuts the short-term rate. When supply and demand imbalances push those long-term rates higher, it neutralizes the Fed's influence and changes the cost of money for everyone. This shift impacts stock valuations directly. Analysts value companies by discounting future cash flows based on long-term yields. When those yields stay elevated, the present value of those earnings drops, forcing stocks to trade at lower multiples. The same math applies to the housing market. Mortgage rates are anchored to the 10-year Treasury yield, meaning if global demand for our debt weakens, mortgage rates stay high and housing remains unaffordable, regardless of what the Fed says. We are also seeing this in corporate credit. The cheap financing of 2020 and 2021 has disappeared, causing risk appetite to fall and business growth to visibly slow as borrowing costs stay pinned at decade highs. The massive unwinding of the yen carry trade is effectively draining the oxygen out of the global system. It proves that the real threats to your money aren't the loud political headlines, but the structural shifts hiding in plain sight.